Hi, I am Mr. James and welcome to another The James Accounting Tutorial. Today we will be looking at Paper 2, 2014 Module 3 of the let's get right into it. Part E. Name two users of the statement of cash flows and to state one reason why each user named would need a statement of cash flows. Okay. Two users would be bankers, trade unions, and there are many others, but we will focus on these two. Bankers need to satisfy themselves about loan repayments from the business, things like bank overdrafts and so on, but to extend them to the business and things like that. And then we have the trade unions who they want to ascertain the ability of the firm to pay wage increase. We classify the following list of items into the headings operating activity, indirect method, investing activity, financing activity, and significant non-cash investing and financing activity. First item we have is the loss on sale of fixed assets, and that would be classified as an investing activity. Issuance of bonds for land as a significant non-cash investing and financing activity. We will notice that the nature of the transaction here, issuance of bonds for land, that no cash passes there. You're exchanging bonds for land. Conversion of bonds for common stock. Again, that's another significant non-cash investing and financing. You have bonds and common shares being exchanged for one another. No cash passes. Purchase of land. That's an investing activity. Redemption of bonds. Financing activity. Payments of dividends. This can go under financing or investing activities. Depreciation. Operating activity. Receipt of dividends on stock investments. Investing activity. Right, that could also interest payments on bonds payable, financing activities, and issuance of common stock, another financing activity. Share, like, comment. The following extract from the Statement of Comprehensive Income of Margarita Company for the year ended 30th June 2010 is as follows, and we are given an abbreviated Statement of Comprehensive Income as well as two extracts from the balance sheet of 2009 and 2010. And we are asked to prepare the operating activity section from the statement of cash flow in accordance with IAS 7 IFRS for SMEs using the indirect method. Okay, so first we will have to do what we call the workings, and I will do it right here on this, and indicating the figures which goes into the statement of cash flows. First, the beginning figure will begin with the income before interest, sorry, and taxes, and that would be this figure here, 2,000 or 5,000, since we do not have any interest. Okay, so our starting figure is 5,000, and there are two items here that does not involve a flow of cash, neither inflow or outflow. They are what we call notional figures, merely calculated and placed in the income statement. So depreciation expense is one of them, as well as the loss on the sale of equipment. And so we add those two marks, and then we come down to the extracts on the balance sheet here, and the accounts payable, account accrued expenses, and so on. These are what we call working capital items. The changes in the working capital items is needed. So for the accounts payable, there's an increase of 7,000. The accrued in expenses increase from 7,400 to 8,700. Accounts receivable from 64,000 went down to 53,200. That's a difference of 10,800. And the inventory is 25,000 increase to 35,000. The tax payable we handle differently, and strictly speaking, that is not really a working capital item. Okay, what we want to find out is the tax paid. We take the beginning balance, and we add to the amount in the income statement of 51,250, and then we minus the ending balance that we are still owing. What we will get there is the amount that we have paid for the year. Okay, we started with this amount, ended this with this amount. The movement between is merely 1,300, but actually we also have this amount here to put in. So it's $51,250 that would be added to the 7,2, and then we minus the amount that we have left to pay. So we get the amount that is paid of 53,950. Next, we will go into the cash flow from operations. Part C, the cash flow from operations. We start with the net income before tax and interest of 205,000. We add back the depreciation and the loss on sale of equipment for 76,000, and we get 281,000. We look at the working capital items. Now, at first, you would not know whether to add these or to minus these, but so there's a simple thing that I can tell you that will help you to get them out at first. The increase in current assets would be an outflow of cash. All increase in current assets is an outflow of cash, and that's all you need to remember. Right? It means therefore that decrease in current assets would be an inflow of cash, and you would add that. And then when you look at the other component of the working capital, the current liabilities, the increase in the current liabilities would be the opposite again, and then you have the decrease in current liability. So all you really need to remember is that an increase in current asset is an outflow of cash, right? So an increase in here, this one for instance is a current liability, and you see it's an inflow of cash. It's the opposite of the one that you have to remember, right? An increase in accruals, same thing. So we add it on. A decrease in the account receivable, right? 10,800. So we add it on. Increase in inventories, increase in current assets. You take that as an outflow and you minus the 10,000 in cash. The payment of tax is a payment, so obviously there was an outflow of cash 53,950. And when we add these together, we would get our cash flow from operations. If we had interest payable, we would put it in here as well. And we would treat it the same way we treated the tax. Take the amount from the profit and loss, add it on to the opening balance, and minus the closing balance. Okay, so that is how we handle this section of the cash flow from operations. Remember, all you have to remember is an increase in current assets is a decrease in the cash or outflow of cash. And from that, you can reason all the others. Here we move on to part D. Share, like, comment. Three limitations of accounting ratios. One, seasonal factors can also distort ratio analysis. Two, different accounting practices can distort comparisons even within the same company. It is difficult to generalize about whether a ratio is good or not. Part E. We have before us some selected data from the books of Hilton Bakery for the year ended 31st October 2010, and we are given some items from our income statement, and then we are given some formulas and therefore calculating ratios. What we are required: one, the gross profit margin; two, the times interest earned; three, earnings per share; four, price earnings ratio; and five, the dividend payout. And well, we have the formula here, so you don't have to rely on your memory. And the first thing you should have noticed here is that there's an important item here. This is not an income statement. There's some items from the income statement, and some important items are missing from it before you can calculate these ratios here. And if you look at it, you should be able to tell that the gross profit is missing, the net profit is missing, as well as other income and is missing. So if you jump right into the answer and you start calculating, you are going to calculate incorrectly and you're going to get wrong answers, no marks. Okay, so first we have to look at the working. So coming up next, the working. Now, one of the things we have to remember when we are doing ratios in particular is when we divide dollars by dollars, we don't get back dollars. What you get is a number of times. For example, if you divide $4 by $2, you do not get $2 as your answer. What you would get is two times. Okay. All right. With that, we take the workings. So here, and I have reconstructed the profit and loss account here, the income statement rather. Sales, that's the cost of sales, give us the gross profit. This was missing. And the other minus the other expenses, we get profit before interest and tax. This also is missing. The interest is 20, and the profit before tax is 166. This was also missing. Corporation tax 28, net income 138. Okay, then we go into the calculations. The gross profit percentage would be 300. From there over the 550, and we multiply it by 100, we get 54.5%. And then we have the interest cover, or the amount of times interest is earned. So we take the net income before profit and tax, before interest and tax, sorry, and 186, and we divide it by the interest itself, and we get, this is dollars divided by dollars, so we get 9.3 times. It means the net income covers the interest 9.3 times. And next we look at the earnings per share here. It's 138, the earnings, divided by 42,000 shares. So we get 3.29, $3.29 per share. Then we have the price earnings ratio, which is the earnings per share, the market price divided by the earnings per share. We get 2.43 times. And finally, the cash dividend divided by the net income multiplied by 100 is 18.12%. So these are your workings, and you need to make a comment on each one of them. So we're coming up with the comment next. Share, like, comment. So the first one we have here is the earnings per share, and what that tells us is that every share outstanding earned $3.29. Doesn't tell you anything more than that because you don't have a comparative income statement or the figures for another company or the industry. So all you can get from that is that every share outstanding earned $3.29. Next, we have the gross profit percentage. What it means is that for every $100 of sales made, $54.50 was profit before operating expenses. You must have this piece here, otherwise this other piece becomes misleading. Okay, it is before the operating expenses. 9.3 times for the interest cover. The profit before interest and tax covers the interest expense 9.3 times. Okay, nothing more than that it tells you. And 2.43 times for the price earnings ratio. It means investors are willing to pay 2.43 years or times earnings of a share for a share. Okay, so this is what investors are willing to pay on the stock exchange for your share. Then we have the cash dividend. This gives us the proportion of the net income paid out as cash dividend. Okay. Hope you learned something from this video. If you did so, I invite you to like it, or if you didn't, you can dislike it. Okay, and I look forward to seeing you in the next video.